Welcome to The Explainer. Ever wonder if a company is really as healthy as its headlines claim? We're about to build a powerful diagnostic toolkit using just a handful of key numbers to help you see the real story, and we'll do it in just 5 minutes. It's a super important question. Whether you're an investor, a manager, or honestly just curious about how business works. Because let's be real, the headlines, they almost never tell you the whole story.
And the book that inspired this explainer, Key Management Ratios, just hits the nail on the head. The great news is you don't have to be an accountant, and you definitely don't have to get bogged down in hundreds of different calculations. You just need to get a handle on the few numbers that really matter.
I love this analogy. Thinking of it like a doctor's checkup for a business. It's perfect, right? We're going to use a few key indicators to check its overall health and spot any potential problems. So let's grab our clipboards and check those vital signs.
So what's the big challenge here? Well, if you've ever looked at a company's financial report, you know they can feel deliberately complex, dense. It almost feels like they're designed to be confusing.
But our goal here is to just cut right through all of that. We're going to bypass the noise and focus on the handful of things that tell the real story, giving you the confidence to see how a company is actually doing. All right, let's get right to it. We're going to start with the two most fundamental measures of performance. Think of these as the company's pulse and its blood pressure. They are the absolute heart of our financial checkup. So we've got these two big ones, ROTA and ROE. Now, at first glance, they might seem kind of similar, but they're looking at things from crucially different angles. ROTA is all about the entire business as one big engine. How well does this whole machine, all its assets, turn every dollar into profit? But ROE, that's laser focused on the owners. For every single dollar a shareholder puts in, what are they actually getting back?
So what's a good number for ROTA? Well, lucky for us, the source material already did the heavy lifting. It looked at a bunch of large, successful U.S. companies and found an average pre-tax ROTA of about 17.9%. So let's just call that our benchmark. If you see a number close to that, you know you're looking at a seriously efficient profit-making machine.
And what about the return for the owners? The really important number, right? Well, for those same top companies, the average after-tax return on equity is a stunning 27.6%. This is what a truly healthy, thriving business gives back to its investors. Honestly, you could argue this is the number that matters most. Because at the end of the day, this is what builds real long-term value.
But how does a company actually get to a great ROA like 18%? It's not just some kind of magic trick. It all comes down to two key drivers working together. So let's pop the hood and see how this engine really works.
Okay, so here's the key idea. A company's overall performance, that ROTA number, is really just a balancing act. It's your profit margin. So how much money you make on each individual sale multiplied by your asset turn, which is how fast you can make those sales. You can be amazing at one or just pretty good at both.
And this is where it gets really, really cool. Think about a supermarket. They make almost nothing on each can of beans, a super low profit margin. But man, they sell them fast. That's a high asset turn. Now flip that. Think about a luxury brand. They have huge profit margins on every single item, but they sell things pretty slowly from expensive showrooms, a very low asset turn. And yet, look at this. They can end up with the exact same healthy performance number by using completely opposite strategies.
Okay, so a company can look great on paper, seem really profitable, but still be teetering on the edge of collapse if it runs out of cash. So now we're going to shift gears from performance to, survival. We're checking for short-term health and long-term risk.
This first test, it's all about immediate survival. It's super simple, really. It just compares a company's short-term assets, cash and stuff it can sell quickly, to its short-term liabilities, which are basically the bills it has to pay pretty soon.
This single number answers that one critical question. Can you pay your bills this year? Yes or no? A number over 1 means, yeah, you probably can. But if it drops below 1, that is a huge red flag. It doesn't matter how profitable you are on paper. If you can't pay your bills, you are in serious trouble.
All right, now let's talk about long-term risk. I like to think of debt as kind of like a performance-enhancing drug. It can totally supercharge your growth and returns, but wow, is it risky? And this next ratio tells us exactly how much of that drug the company is using.
So this ratio answers a really fundamental question.
Who's funding this company? Is it the owners, or is it the bank? A high number means it's running on a lot of borrowed money, which is awesome when things are going great because it magnifies profits. But if there's a downturn, that same debt can become a massive anchor that just drags the whole company under.
Okay, so we've looked at performance, we've looked at what drives it, and we've checked for the biggest risks. Let's put it all together and assemble our final diagnostic toolkit.
And there you have it. See? It's not about memorizing like 100 different things. It's about mastering just a handful. With these 6 numbers, ROTA, ROE, profit margin, asset turn, current ratio, and debt to equity, you've got this incredibly powerful framework to analyze basically any business out there. And that's really the power of this. It's not about finding one single right answer. It's about you having the tools to look past all the hype, ask smarter questions, and really see the story the numbers are telling. So the next time you see some big business headline, just ask yourself, what are its vital signs? What's the real story here? Thanks for joining The Explainer.